Pharmaceutical industry in India, recent trends. Introduction and short history of the Indian pharma industry, COVID-19 to 2024. The Indian pharmaceutical industry has been a cornerstone of the global healthcare system for the last 2 decades or so, primarily due to its role as a leading producer of generic drugs and vaccines. The COVID-19 pandemic, however, catapulted the industry into an unprecedented period of growth and global significance. From being the pharmacy of the world, supplying essential medicines and vaccines to over 200 countries, the Indian pharma sector has witnessed a remarkable transformation between 2020 and 2024. This period has been marked by robust revenue growth, significant challenges, and an increased focus on innovation and self-reliance. The industry also had a strong dependence on China for many ingredients, mainly the APIs. Further, Indian companies have become bigger, more profitable, and have gained greater global recognition, so this also opens new opportunities for the industry. Many companies are increasingly often investing internationally, even more aggressively, looking at opportunities in new molecules as they are increasing their size and standing in the world. In this short video, we will have a quick look at how is the industry evolving after COVID-19 and particularly in Q1 FY25. We will look at the growth of the Indian market, major Indian companies, their position in the global markets, and what are the recent initiatives of these companies. We will also in a new series examine the events in a few chosen industries 2 to 4 times every year, where we will look at the financials of major players, global dynamics, key issues and opportunities for these industries. While we will rely on various communications such as investor presentations and con calls, we will go beyond these and also do field research on many industries to bring you first-hand information. We also do competitive studies for various clients in many industries. Revenue growth and market dynamics. Domestic market. During the pandemic years, the domestic market for the pharmaceutical industry experienced a surge in demand, particularly for COVID-19 related treatments. According to the Indian Pharmaceutical Alliance, IPA, the industry's domestic market grew at a compound annual growth rate of approximately 12% from 2020 to 2024. In FY 2022, Sun Pharmaceuticals, the largest pharma company in India, reported a 14% year-on-year growth in its domestic formulations business, reaching Indian rupees 12,000 crores. Similarly, Dr. Reddy's Laboratories and Cipla saw their domestic revenues increase by 13% and 10% respectively, driven by higher demand for chronic and acute therapies. United States market. The US remains the largest export destination for Indian pharmaceuticals, accounting for nearly 30% of the total exports. The US generics market, valued at around USD 70 billion, has seen a steady influx of Indian generics. In FY 2023, Lupin Limited reported a revenue of USD 780 million from the US market, constituting 38% of its total revenues. Companies like Aurobindo Pharma and Zydus Life Sciences also witnessed substantial growth in their US operations, with Aurobindo's US formulations business contributing to 48% of its total revenues, amounting to USD 1.7 billion in FY 2023. The approval of complex generics and biosimilars such as Biocon's interchangeable insulin biosimilar, Simgli, further bolstered the revenue streams from this market. Emerging markets. Indian pharma companies have increasingly turned to emerging markets such as Africa, Southeast Asia, and Latin America to diversify their revenue base. In FY 2022, Cipra's business in Africa grew by 11%, while Dr. Reddy's saw a 15% revenue growth in the Russia and CIS markets. The Vaccine Maitri initiative by the Indian government facilitated the export of over 66 million doses of COVID-19 vaccines to various countries, strengthening India's position in these regions. As per a report by ICRA, the revenue from emerging markets is expected to grow at a CAGR of 13% from 2020 to 2024, driven by the increasing demand for affordable healthcare solutions. Many pharma companies have also reported erratic market growth and even degrowth in certain markets, particularly in the institution business, which depends on funding to and from WHO, economic factors in various economies, etc. Challenges and growth factors. Supply chain disruptions. The pandemic exposed critical vulnerabilities in the supply chain, particularly regarding the dependence on China for active pharmaceutical ingredients, APIs. The Indian government responded with initiatives like the Production Linked Incentive PLI scheme, which earmarked Indian rupees 15,000 crores to promote domestic API manufacturing. Despite these efforts, companies like Sun Pharma reported a 6% increase in raw material costs in FY 2021 due to supply chain disruptions, highlighting the ongoing challenges in achieving self-reliance. Regulatory hurdles. Indian pharma companies have faced regulatory challenges, especially in the US market. In 2021, Lupin received several warning letters from the US FDA for its manufacturing plant, impacting its US revenue by nearly 5% in FY 2022. To address these challenges, companies have been investing in compliance and quality control measures. For instance, Cipla allocated over Indian rupees 500 crores towards upgrading its manufacturing facilities to meet global standards. Innovation and R&D investments. The industry's shift towards innovation has been evident in the increasing R&D expenditure. In FY 2023, Biocon Limited reported an R&D spend of Indian rupees 1,250 crores, accounting for 13% of its revenues, with a focus on biologics and biosimilars. Sun Pharma's investment in R&D also saw a 10% increase in FY 2023, reaching Indian rupees 2,300 crores, driven by the development of complex generics and new chemical entities. Current status of the industry. Number 1, sales growth. The pharmaceutical industry in India has shown robust growth in sales across the board, with most companies reporting significant year-over-year and quarter-over-quarter increases. Sun Pharma, the largest pharmaceutical company in India, recorded a 10% year-over-year growth and an impressive 16.4% quarter-over-quarter increase. This growth can be attributed to its strong product portfolio and expansion into new markets. Divi's Labs outperformed with an 18% year-over-year growth, driven by its strong presence in the API, active pharmaceutical ingredient segment, which saw heightened demand. Zydus, another major player, reported the highest year-over-year growth at 20.8%, reflecting its successful launch of new products and strategic market expansions. Mankind Pharma and Dr. Reddy's also reported solid year-over-year growth rate of 12% and 14% respectively. However, Cipla lagged behind with a 7% year-over-year growth, slightly below the industry average of 13.6%. This slower growth could be due to increased competition in some of its key markets. Overall, the sales growth across these companies indicates a healthy demand for pharmaceutical products both domestically and internationally. The varying growth rate also highlights the differing strategies and market focuses of these companies. Regional growth summary. India. The Indian market remains a robust growth driver for the pharmaceutical industry. Sun Pharma recorded a 16.4% growth in Q1 FY25, outperforming the Indian pharmaceutical market IPM, while Dr. Reddy's achieved a 15% year-over-year increase. Zydus Life Sciences also saw significant growth with a 12% rise in its branded formulations business, driven by both chronic and acute segments. US. The US market continues to be a key focus with notable gains. Zydus Life Sciences registered an impressive 26% year-over-year growth, driven by new launches and volume expansion. Dr. Reddy's reported a 19% year-over-year increase in North American revenues, largely due to higher volumes and market share expansion. Sun Pharma also saw growth in its specialty business, although specific percentages were not disclosed. Europe. Growth in Europe has been moderate Dr. Reddy's reported a 4% year-over-year growth in the region, supported by new product launches and increased base business volumes, which helped offset price erosion. Emerging markets. Emerging markets showed steady growth, with Sun Pharma achieving an 8.8 year-on-year increase in branded formulation revenues. Zydus Life Sciences reported a 9% growth, while Dr. Reddy's saw a more modest 3% year-over-year growth, offset by unfavorable forex and a sequential decline of 2%. Number 2, profitability, robust EBITDA margins. The profitability of the Indian pharmaceutical industry has seen notable improvement as reflected in rising EBITDA margins. The average EBITDA margin across the 6 companies analyzed stands at around 28%, highlighting effective cost management and a focus on high margin products. Cost management. Companies have implemented cost optimization measures such as efficient procurement strategies and streamlined manufacturing processes to mitigate rising raw material costs. Cipla, for example, has successfully reduced its cost of goods sold COGS by 2% through strategic sourcing and process improvements, contributing to an EBITDA margin of 25.6%. High margin products. The shift towards high margin products such as biosimilars and specialty drugs has been instrumental in maintaining profitability. Sun Pharma's specialty segment reported a 14.7% year-over-year growth, contributing to an overall EBITDA margin of 28.5%. Dr. Reddy's also benefited from its focus on complex generics, which helped it achieve an EBITDA margin of 28.2%. Number 3, Forex impact. Foreign exchange volatility is a significant factor for pharmaceutical companies, especially those with substantial international operations. Sun Pharma reported a forex loss of $505 million, reflecting the challenges posed by currency fluctuations. This loss could be attributed to its extensive global presence, making it more susceptible to forex risks. Dr. Reddy's, on the other hand, took a more proactive approach by hedging $858 million across various currencies, including GBP and AUD. This strategy helped mitigate potential losses from currency fluctuations, demonstrating the importance of effective forex management in maintaining financial stability. The other companies did not report significant forex impacts, suggesting that they either had minimal exposure to financial risks or manage their forex operations effectively. However, the substantial loss reported by Sun Pharma underscores the need for robust risk management strategies in a volatile global market. Number 4, material costs. Material costs as a percentage of sales are a crucial factor in determining the profitability of pharmaceutical companies. The sector has seen varied material costs as a percentage of sales averaging around 25 to 30%. Companies have been able to manage these costs effectively despite fluctuations in raw material prices and supply chain disruptions. Mankind Pharma had the lowest material costs at 16.3% of sales, giving it a competitive advantage in terms of cost efficiency. Sun Pharma followed with material costs at 21.4% of sales, demonstrating its ability to manage input costs effectively. In contrast, Divi's Labs reported the highest material costs at 40% of sales. This high percentage could be due to the nature of its API business, which often involves higher raw material costs. Cipla's material costs were 33.1% of sales, but it managed to reduce this by 7.2% quarter over quarter, indicating effective cost-cutting measures. Other expenses. Few companies in the pharma industry have high other expenses compared to other industries. Similar trend has been observed during this quarter, with Sun Pharma having other expenses at 30.1% of sales and Mankind Pharma at 26.5% of sales. Apart from other expenses, the employee costs also tend to be extremely high for pharma companies. These have also increased as the companies have added field sales force in many geographies. The new field executives take a certain amount of time before their productivity matches the more experienced employees. In the Indian market, the field productivity of Sun Pharma is considered to be the highest in terms of sales per field executive. EBITDA and net profit after tax (PAT). The financial health of the Indian pharmaceutical industry remains robust, as reflected in consistent growth in EBITDA and PAT. The industry has successfully converted sales growth into profitability with average PAT growth of around 19.6% year over year. This positive trend is supported by disciplined cost management, strategic investments, and a focus on core therapeutic areas. Key factors contributing to this financial performance include sales to EBITDA conversion. The industry's ability to effectively convert sales into EBITDA has been a major driver of profitability. This is largely due to the effective management of operating costs, the introduction of high margin products, and the optimization of manufacturing processes. EBITDA grew at 6.85% on average within the industry, with Zydus being an exception with 38.4% year over year growth. New product launches. Innovation and the introduction of new products are crucial for maintaining competitiveness in the pharmaceutical industry. In Q1 FY25, Sun Pharma launched 6 new products, contributing to its strong sales growth and market expansion. Dr. Reddy's was also active, introducing 13 new products in North America and 12 in Europe, emerging markets 17 and 13 new brands in India. Cipla has done 7 new launches in South America and has launched 2 new brands in India. This focus on new product launches is a key driver of growth for these companies, allowing them to capture new market segments and meet evolving consumer needs. In an industry where competition is fierce, the ability to continuously innovate and bring new products to market is a crucial factor for success. Companies that invest in research and development, R&D, and are agile to their product development processes are better positioned to maintain long-term growth. R&D investments. Investment in R&D is a key driver of innovation and long-term growth in the pharmaceutical industry. Dr. Reddy's led the way in Q1 FY25 with R&D spending of 8.1% of sales, reflecting its strong focus on innovation and new product development. The substantial investment in R&D positions Dr. Reddy's to capitalize on future growth opportunities, particularly in the generics market and new therapeutic areas. Net cash position. The net cash position is a vital indicator of a company's financial stability, reflecting its ability to meet obligations, invest in growth, and withstand economic challenges. Based on the Q1 FY25 data for the 6 pharmaceutical companies, the industry's overall net cash position is strong, though there is some variation among the firms. Companies like Sun Pharma and Dr. Reddy reported robust net cash positions, with Sun Pharma holding a net cash balance of approximately Rs 192 billion and Cipla maintaining around Rs 808 million. These reserves provide significant financial flexibility, allowing them to invest in research and development, pursue strategic acquisitions, and effectively manage working capital. The overall positive net cash positions across the industry highlight the company's capability to reinvest in growth opportunities without significantly increasing leverage. This financial stability is essential as the industry continues to navigate competitive pressures and invests in innovation and market expansion. With many companies having large cash reserves, we would expect to see some large global acquisitions from the Indian industry. These could easily be multi-billion-dollar investments. Many of the top-tier companies have more than $1 billion in cash equivalent and have strong profitability and ability to service acquisition debt fairly quickly. Industry challenges. The pharmaceutical industry in India faces several challenges, including pricing pressures across large volume products, price erosion in some of the cash cows of the industry, regulatory hurdles, hyper competition in trade generics, and competition from both domestic and international players. Future expansion strategies. There are various strategies that the companies have planned. Majorly, most of the companies agree on. Geographical diversification. Most companies are actively expanding their presence in emerging markets, particularly in Latin America, Africa, and Southeast Asia. Portfolio expansion. Companies are increasingly investing in the development of complex generics, biosimilars, and specialty drugs to differentiate themselves in the competitive global market. Increased presence in specialty products. Conclusion. The Indian pharmaceutical industry has demonstrated remarkable resilience and adaptability in the face of challenges, delivering strong growth and profitability in Q1 FY25. The industry's focus on innovation, cost management, and market expansion has been key to its success. As the industry continues to evolve, it is well positioned to capitalize on emerging opportunities, drive innovation, and contribute to global healthcare solutions. If you like this video, please consider subscribing to this and share it with your friends and colleagues. This will be a regular quarterly feature on our YouTube channel. A more detailed in-depth analysis will be available as a priced report on PDF. We will in due course cover several industries. We also do in-depth competitive analysis of several industries which are updated regularly. If you need in-depth annual report analysis of your company or your competitors for board presentations and for orientation of new directors, please contact us.